Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's the first one for this week. I apologize for yesterday. We had power cuts. We're still having power cuts, but I'm on a generator today, so apologies for yesterday. So this is the first morning market review for this week. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com, and of course, if anyone wants to contact me, I encourage sending emails through to me. And today is Wednesday. It's the 20th of April. So we're going to we'll go up to sort of the top of the hour. Then I'll switch to the crypto minute, and so let's see what we can get through for this 15 minutes. Here's our high risk investment warning. I'll just keep this on screen for a few moments, and hope everyone had a really good long weekend. And again, apologies that that I missed yesterday. Hey Rob, no worries, and it's really such a pleasure to have you back on the webinars. Glad to have you. I'm just going to bring the market commentaries disclaimer on as well. Hey Howard, morning to you, morning to everyone for joining. Thank you very much. And it's actually a really interesting, very interesting time in the markets. If you guys saw any of the news for Netflix, so Netflix is last I was looked at it was down 20%. That's because they had a net loss of subscribers, a net loss. Now we have to be we have to adjust for Russia, because they have they've cut services in Russia, so they lost 700,000 subscribers. If you take that 700,000 out, Netflix actually did gain subscribers, but they only gained 500,000, and I think the forecast there was for 2.5 million. So when you take the adjustment for Russia, there is a gain of 500,000. Without adjusting, it's they lost 200,000. But the market really is of the opinion that Netflix, a lot of trouble here because of the competition. So that's just something that we should be aware of. Another result I found interesting was Johnson & Johnson. So they missed on revenue, I believe, but more importantly, they adjusted forward guidance downwards, and I think that's what we're going to see. I want to talk about that this morning. Are we going to see this forward guidance being sort of yeah, I've lost the word. Downgraded is what I'm looking for. I beg your pardon. All right. Here's our references: MarketScope 2.0, CNBC Trading View. Let's just go through the CNBC market article for this morning. This is the European article. It reads: European stocks heading for higher open as markets monitor Ukraine and growth outlook. Another news story: IMF has cut growth outlook for global growth. So that's covered in this article. European stocks are expected to open higher on Wednesday as investors monitor development in Ukraine and assess the IMF's latest global economic forecasts. European markets continue to focus on the war in Ukraine. The conflict has entered a second phase in which fierce fighting has begun in the east of the country. Ukraine said on Monday that Russia's offensive in the eastern Donbass region has begun, with a top official describing it as the second phase of the war. The eastern city of Crimea fell to Russian forces on Tuesday, its regional governor said, marking the first city to be captured in this phase of the war. Investors are also digesting the latest gloomy global economic forecasts from the International Monetary Fund and World Bank. On Tuesday, the IMF cut its global growth projections for 2022 and 2023, saying the economic impact for Russian invasion of Ukraine will propagate far and wide. On Monday, the World Bank lowered its global growth forecast for 2022 by nearly a full percentage point, from 4.1 to 3.2%, citing the pressure that Russia's invasion of Ukraine has placed on the global economy. Data releases include Eurozone industrial production for February and new car registrations for March in a number of European countries, including the UK, Germany, and France. Earnings come from Heineken, ASML, and Rio Tinto will publish first quarter. Okay. Bearing in mind, also we'll see Tesla come out. I think it's, my goodness, I think it's today. So keep an eye on that, considering I'm not sure if there'll be any notes there for Elon Musk's bid for Twitter. Twitter is reporting on the 28th of April as well. So just a very, very interesting time in the markets. Okay, let's just have a quick look at the DAX. This is our weekly chart. All right, so let's just put in a fib here. I'm just going to bring in a 62% fib. All right, so this fib over here, I think, is being watched by the market. Again, I want to stress, you know, it's highly doubtful that markets turn because they're at Fibonacci levels. It's more likely that they turn because traders are acting at Fibonacci levels. And if that is the case, then the 62% level over here should be regarded as resistance, because I think it's still going to be watched. All right. What does that mean? Well, it means that our bear market rally scenario is still very much alive. There's still a potential for that. So we wanted to keep that in mind, that the risks in the risk market still certainly there, and let's just keep an eye on the peaks and troughs here. So let's just add in some labels. I want to put in a reference trough over here, and I want to put in a reference peak over here. So now we're going to measure this by using these two labels, and I think that's going to help us assess whether we are in a bear market rally. How's that going to do us? We're just going to carry on labeling. So this over here looks like it could be a higher trough. Well, that's actually bullish, but I'm going to put a question mark there because it's not confirmed. Okay, and then let's just say we do get a reference candle over here and it moves like so. That's actually a higher trough, higher peak. That would be a much more comfortable position for the DAX to be in. So that's the one scenario, but it's all depends on what happens here. So we've got this resistance above us. Is it still going to influence and push markets down? Now, the technical, let's just build a technical case, and then let's talk a little bit about a fundamental case that may signal bearish pressures. The stochastic would need to turn down. Okay, if this is a bear market rally, we will need to see stochastic turn down, and importantly, we will need it to hit its lower quintile area and hold it. That's going to put pressure on the index. And oh, I don't know what I did there. I deleted that. Let me just bring that in. All right, I'm begging your pardon. All right, so just keep an eye on the stochastic and see if it makes its way through to the lower quintile. Now, let's just explore this very quickly, cognizant of time here. Think about the stochastic in terms of a candlestick or a bar chart. That's the way I think of it, and it's range bound between 0 and 100. So it's effectively a percent counter, isn't it, from 0% to 100%. So think about it. Let's just put in a range. Let's put in a range, and we can put in a range is simply the high minus the low will give us the range. Okay, And if we are sitting under 20 on the stochastic, just think that the close is sort of in the lower fifth of the range. Well, that's bearish. That's bearish momentum. There is that explanation that I've just given you is not 100% true, because we've applied slowing factors to the stochastic, but I think it's in the spirit of the stochastic. So a lot of textbooks would say, well, if it goes below 20, that's oversold. If it goes above 80, that's overbought. That's a big mistake. Mathematically, you basically, if you're buying in the 20 area, you're going long in bearish momentum. If you short in 80, you're going short in bullish momentum. That's just a recipe for disaster. That's not what the stochastic tells us mathematically. So the idea here is, if we do have this bear market rally, okay, and it hits the lower quintile, well, that's trouble. Now let's just explore that. So we only got 5 minutes left here. What could effectively put pressure on the index? And for that, we're going to go through to trading view. All right, all right, so I'm just going to bring up USD CPI. This is core, US core inflation. This is not my preferred. It's not my preferred series on TradingView. There's a Fred series here which I just can't find at the moment for some odd reason. And just this number here, this 4.5% is so we're a little bit sort of behind it. This should be 6.5. It's okay. Okay, so there's some data discrepancy here, but the point is, if we add a yes, certainly. Well, can I post a link to the crypto webinar? Yeah, definitely can. All right, that's weird. I hope nothing's happened. I'll take a look at that in a moment, Howard. So let's just add an RSI here. Oh, the next crypto is on May 11th. Oh, okay. Well, you know what? We'll do the crypto on this webinar. Okay, do the crypto on this webinar. Sorry about that, guys. There must be a gap in the list. All right. All right. So what we have here is the US core CPI. If I put in all right, so we go back to here is the first oil crisis. Okay, here is the second oil crisis. Okay, there is some sort of I think this is the Asian currency crisis here. 1969 is actually overbought as well. That's why this series doesn't go back enough to give us the overbought. There is an overbought reading here, believe it or not, over here. 10. I just always use 10 HL2. Always use 10 HL2. Again, I don't think there's any magic numbers there. This is the one that I sort of have defaulted to. Yeah, it's the RSI, correct? Yeah. And then you can see we're kind of getting to this overbought level here as well. The reason that we are looking at core is, well, you know, the core number moderated last week somewhat. It came under expectations. This is actually overbought. This series I'm using is not the correct series. This is actually should be sitting at 6.5 now, so we actually are above 80. So the question is, well, are we are we moderating in core inflation? And I think that we certainly could be, but I would suggest that we need more information. Okay, I would suggest that we need more information and more data points, because take a look at it in this way, which I think is quite helpful. So let's get rid of this. Let's change this up to producer price index. All right. So this is PPI. So this is now inflation from the producer side. Okay. This is the correct. So this is the correct series. The time here, the time, the x-axis here has moved up. You can see to March 22. We had an astounding 11.2%. Now, usually PPI is not as highly regarded as analysts, or at least in my experience, it's not as highly regarded, because it's really, consumption is about 2/3 of GDP. So if it's 2/3 of GDP, the CPI really tells us everything that we need to know. But I'm going to posit that that's not the case when PPI is spiking. I'm going to posit that the PPI becomes incredibly important when inflation is spiking. And the reason for that is that it tends to lead CPI. The producers will pass on these spikes to consumers. So how are we going to see if that's true? Well, we're going to add the core CPI to this. And again, I apologize, I'm not finding the right series, but this one's good enough for us for this. So so we've got this orange guy here. This is the core CPI. I'm just going to make this blue. So let's go back. Here is the first oil crisis. Here's the second oil crisis. Here's the current oil crisis. The black series is PPI. The blue series is CPI. What's happening here? PPI moving up. It's leading CPI. All right. What's these vertical dashes? Well, this is actually when the PPI starts crossing below CPI. In other words, the producer, it's leading CPI. It leads CPI up in a spike. It leads CPI down in a spike. But listen very carefully, not just CPI, core CPI. So even though the core number has stripped out the volatile items, I'm not sure that is acceptable when there's spikes in inflation, because the supply side shocks are influential no matter. And you can see, come the first oil crisis, PPI leads CPI up, PPI leads CPI down. Come the second oil crisis, PPI leads CPI up, PPI leads CPI down. Where are we right now? PPI leading CPI, core CPI up. I am at a disadvantage because this blue line hasn't got the latest data. I just can't find it. I've searched. It is in TradingView. I just, for some odd reason, haven't been able to find it. So the call for core CPI to be topping may be correct. I can't say it's incorrect, because forecasts are forecasts. They're either right or they're wrong. But what I can say is that the spike in PPI is probably more influential than we give it credit for, specifically in these times of spikes. Over here, this area here, I would suggest PPI is less important. Okay, it's less important. But when we get these inflation spikes, it makes the world of difference. And I think that is something that we need to also focus on. So if that's the case, well then core CPI hasn't really topped, okay, which again, I want to reiterate, it might have. I mean, the market participants or the market analysts calling for a top in CPI, maybe they're right. I don't see it. I think that we've still got an ominous influence here in terms of the PPI, and I don't think that's letting up because of the supply shocks. Okay, we've still got this the global supply issues because of geopolitics and because of China lockdown. And I think that story is ongoing. Now, what's the big deal? Why are we spending so much time on this? Well, we have to link it to our original discussion. The original discussion is that we still may be in a bear market rally here. Now, again, we may. I don't know. However, this 62% I would suggest is formidable. And then if we get these spikes in PPI, okay, which are ongoing, well, that's going to put a squeeze. It's going to put a squeeze on company income statement margins. Okay, that puts a squeeze on margins. Okay, that's going to flow all the way from the top to the bottom line. It's going to flow through to your net operating profit after tax. It's going to flow through to your cash flow statement, which is effectively where a lot of the valuation is done. So the squeeze on the margin is one factor, but then, okay, we've got something else to consider here. Okay, the last thing, we've got one more thing to consider here. All right, and if we go through to our 10-year, okay. All right, so our 10-year is now sitting at 2.92%. That's interest rate. Okay, so effectively, take a look at this. Okay, I'm just going to bring up Microsoft Paint, and then I'm going to switch to the cryptos. We've previously used a time value of money equation just to make a point where we've got cash flow divided by 1 plus, and we'll just call it I instead of R to the N. So now in our previous discussion over here, we actually argued completely on the denominator side, saying that the increase in the denominator is, why is the denominator increasing? It's increasing because you can see interest rates are increasing. Okay, interest rates are on the denominator, so the denominator is getting higher. But if the denominator is getting higher, present value must be coming down because the present value is a numerator, interest rates a denominator. There's an inverse relationship there. But now I'm going to argue that, well, there's a double whammy here, and that's the cash flow is also probably going to get hit. Why is the cash flow going to get hit? Is because margins are going to start getting placed under pressure because we've seen the PPI index. Okay, so that's going to put more pressure on the present value. Okay, so we've kind of got this fundamental situation which suggests that the story is not over yet in the markets in terms of bearishness. So we'll keep an eye on that. Already last week we saw the banks coming out. A lot of the banks had problematic results. I think Goldman's was good, but the others were like not great. JP Morgan wasn't good. It's just and they set the tone. We've seen now Netflix is starting to struggle. Netflix is starting to struggle from a competitive point of view, but I think that there could be economic forces there. We've seen that Johnson & Johnson now has lowered its forward guidance. So we just want to keep an eye on what the forward guidance is saying about those margins. And remember, it's all about now if the stochastic rolls over and hits the lower quintile, gee, that could be the market starting to discount that. So let's just keep an eye on that. Pete saying we're going into a commodity-driven economy, not financial manipulation. I don't think this is manipulation. I think this is supply shocks, which of course could benefit the commodities. This is gold. I think also, Pete, obvious candidates to keep an eye on is dollar, right? Obvious candidates. So the dollar looks a little hot here, but look at the momentum behind it, you know, and that's because the I think that's because of this, because of the PPI chart. So I think that. So what's the problem with this type of chart, and what terrifies bankers is, of course, the inflation expectations. So if I expect prices to be higher, I'll bring my consumption forward. But if the consumption is brought forward, that's adding more. That increases demand. That puts more inflationary pressures on. But it also means that, well, when I go into sort of my wage negotiations, I would say to my employer, the cost of living is up. You've got to pay me more. And it falls into a spiral, and that spiral can actually spiral out of control. And I think that's what the Fed is aware of and really fearful of. And not just the Fed. We've seen the RBNZ and the Bank of Canada raised by 50 basis points last week as well. I think that the whole idea for the Fed is to cut that psychology as quickly as possible, get a handle on inflation, and rebuild from there. And I think that's what we are effectively in the middle of. All right, if there's any questions, just go and type those in. I'm going to go through to our cryptos in a moment. Any questions? Okay, Anna, are you happy with those parameters? I'm going to just bring up the cryptos here. Cryptos, all right. All right, let's bring up Bitcoin. So let's just, in my slides, my introductory slides, I do have CoinDesk as I do have CoinDesk as a source, because I just want to read just like we do the CNBC article. I think it's probably worth us also starting to introduce CoinDesk articles here. So the article I'm reading is from yesterday, just as the market closed, and the headline from CoinDesk Market Wrap: altcoins outperform as sentiment improves. Bitcoin within value zone. That's the article headline. And Bitcoin and other cryptos traded higher on Tuesday, as bearish sentiment over the past week appears to be fading. Most altcoins outperform Bitcoin, suggesting a greater appetite for risk among traders. And just to see here, meanwhile, decentralized finance tokens rose more than 7% on Tuesday. Sentiment is also starting to improve among crypto traders, evidenced by a slight uptick in the Bitcoin Fear and Greed Index on Tuesday. And there's a link in CoinDesk to the Fear and Greed Index. I'll just show it to you. Okay, the link takes you to this page, alternative.me. So again, not on my resource page, so I just want to highlight that we're on this alternative.me Greed Fear Index. That's from CoinDesk. Right, let's stop there. Let's do some analysis and see what we can see. And okay, so we'll use the same approach that we did with the DAX here, but there is an obvious difference. I'll point out the difference in a moment. So the approach that we used was to use a fib. Okay, so so we'll go through and we'll use a fib here, and okay, so it's pullback. The pullback here for Bitcoin is to 38.2% fib, as opposed to the DAX, which pulled back all the way to the 62%. So from this leg, it only has pulled back. It's a shallow pullback, which again, well, which instrument will have more strength? The one that pulls back to 62% or the one that pulls back to 38%? Clearly, the one that pulls back to 62% has more coal in the engine, right? So this pullback to the 38.2% is shallow. And the obvious question is, well, do we have some sort of bear market rally here? And a case can be made for that. Okay. You can put in a flag here. Okay. Can even change this to maybe a wedge. Okay. So you do have this kind of worrying patterns, but I think the way to analyze this is not to use the patterns, because truth be told, there is bullishness here. You've got the trough peak. Okay. You've got the higher trough, and of course you've got the higher peak. So a little bit. So we've got sort of an ambiguity here. You've got the Bitcoin that only pulls back 38% of its previous impulse down. That's not a particular good show of strength. But despite that, it still has managed to form up a bullish trend. If this bullish trend is in fact a bona fide trend, then clearly we're at a very interesting point on the chart, because what we can do is look for the next higher trough, which could easily be here. Okay. Could easily be here, but that's still to be determined. All right. In terms of the moving average is weak. Okay, so again, it's an ambiguous situation. It's below moving average. Moving average is turned down. That's the Stan Weinstein moving average. We have got a potential continuation pattern here, continuation down, and with all of those negatives, somehow Bitcoin has managed to form up a higher trough, higher peak. That means that we need to watch for the next higher trough. So we'll just put this in here, and we'll put it as a question mark. Clearly, for Bitcoin to have any sort of momentum, we want to see that reflected in the stochastic. The stochastic right now is sitting in no man's land. It's very weak. Okay, it's not weak. Sorry, it's not strong. It's not weak. It's just neutral. It's just, in other words, the momentum here is still wanting, and the RSI needs to pop above 50. Okay, so a conundrum, is Bitcoin truly bullish? Well, in terms of trend analysis, yes, it's got the higher trough, higher peak. However, there are worrying signs. But it's not only Bitcoin that has worrying signs. It's we saw the DAX has worrying signs as well. It's a potential bear market. It's a potential bear market rally. The idea here is, okay, where I think this all comes down, what this all really hinges on: Bitcoin to the USD, gold to the USD, DAX based on margins. I think this is all very much dependent on this chart, and this chart is going to influence this chart. Okay. And this chart is going to affect the US dollar chart. So you can see how the intermarket forces seem to be working here. So let's just keep an eye on where Bitcoin goes from here. Let's just plan for the various scenarios. So that the bullish scenario would be higher trough, higher peak. Okay. The bearish scenario would be lower peak, lower trough. Okay, so we've got to see which way. By the way, that lower peak, lower trough, that would be the breakout from the wedge. Okay, or the third is just some sort of neutral movement to the side. So those are the scenarios. Hasn't it pulled back roughly 50% from the peak? Has it? Over here, you're looking at the 50% there. Yeah. I think that let me ponder this. I mean, it's not quite 50%, and it's not quite 38.2%, right? It's a little bit higher than 38, a little bit below 50. I don't think the fib level here. I don't think the fib level here gives us much, except that it shows us that the pullback has been less than in the risk markets. Okay, so if we go back, say, to DAX, okay, we've got clearly a 62% retracement there. I wouldn't put too much importance on the fib itself. What I would watch for is the peaks and troughs. Do we get the higher trough, higher peak? Do we get the lower peak, lower trough? Do we get some sort of momentum generation? At the moment, we're in the middle of sort of no man's land. It's not a particularly good place to be for a trader because there's no momentum. Let's just go down to a daily chart and see if we can glean anything further from that. Does that help at all, Howard? Anna's saying there's a good video from Benjamin Cowan where he adds an RSI to the fear and greed index. Okay. Yeah, I mean, I like using the RSI, particularly, I think you guys know, from our point of view, I like using it in terms of extremes. So I think that it's a really good indicator that you can use on most series because it does measure internal rates of change in quite a satisfactory way. So I do like applying RSIs, especially for the extremes. I like the stochastic for momentum as well. To be fair, and I need to do my own work into the fear and greed index and come up with some sort of sense about it. But nevertheless, the chart in of itself, I think, is a conundrum. Uptrend, lack of momentum. We've still got this real worry of PPI putting core CPI up. Let's go down to the daily chart here. Let's just make sure we're looking at the correct instrument. And this over here, again, I would suggest is it's a worry in terms of the zone analysis. If we put in our zones, we'll have zone 1, zone 2, zone 3. Now you can see that we're in this zone 3 area, which is not a comfortable place to be in for longs, because the longer it stays in zone 3, the greater the chance of capitulation. We really need to get back into zone 1, because zone 1 is what pushes it up. So this over here is not a particularly comfortable position. So let's just add the explanation of the daily using the weekly. We have the situation where the weekly momentum, okay, is in really neutral. It's, think about it in terms of your range. If we had to draw sort of a tick here, it would be roughly in the middle. And if I had to say to you guys, well, which way is momentum? Are we bullish or are we bearish? You'll say, well, it's not really clear, Russ. You know, we're kind of sitting in the middle, and I would suggest that's where we are. So more work to be done here, and it comes down to can we build this higher trough here? Okay, so this is important now. Can we build the higher trough here? Because if we don't build that higher trough, well, then there's something that's looking quite ominous, and that's this pattern over here. Okay, so let's see if we can get through to zone 2. Now, this over here looks quite dangerous from a technical perspective. 1, 2, 2, 3. Okay, is this going to be the next 1, 2? Okay, so we just want to watch that. Let's go down to the hourly just to conclude the Bitcoin analysis, and you can actually see the lack of momentum here. It's very clear. Okay, so there's the lack of momentum there, and here's the lack of momentum here. Let's just go back a bit more. And sort of a sideways movement there. So there's that weekly lack of momentum. If we concentrate on just the sorry, just trying to get in here, get closer. If we concentrate on where we are right now, it's looking a little odd in that we do have a bearish crossover here. The bearish crossover, again, just the angle here is pretty flat. What does that angle mean? Pretty much a lack of momentum. So there does seem to be some sort of downwards bias here, but no real conviction to it. And we'll just see we get a cross here. So if we get a bearish cross on the EMAs, if we get a bearish cross on the stochastic, and the stochastic starts moving this side, okay, well then we may get the downwards movement here, okay. But again, the lack of momentum here is obvious. Okay, I'm not sure we're going to get an impulse down here, but it doesn't look like we're heading up anytime soon either. So a distinct lack of momentum here influencing Bitcoin, and that lack of momentum seems to be from a top-down approach coming from the weekly. Okay, so let's just keep an eye on this. We can just have a quick look at Ethereum as well. I'll just put in the peaks and troughs. Okay, so I think the analysis here would be similar, which is not surprising. The crypto seem to move very well in terms of correlation. Let's just put in a. Okay, so here's a 50% retracement. Okay, so Ethereum does seem to be the stronger crypto. Again, just take a look where we are here. We need this to move here. It looks a little more positive than the Bitcoin weekly. If you go back to the Bitcoin stochastic actually was rolling over. Okay, so it was rolling over. Ethereum showing some relative strength there, and you can see that the Ethereum perhaps the better of the two. If we just go through to Ethereum's daily chart here. All right, again, it's not the best looking zone analysis. We are in zone 2, which again, better than Bitcoin, but gee, we're on the border here. Okay, so Ethereum really needs to start moving towards the zone 1. And let's just go down to the hourly. And again, I think a little bit more positive than Bitcoin in that it does look as if there could be some sort of rollover there. We just need the angle and separation here. And then if Ethereum can push its way through to 80, well, then it will be moving towards zone 1. And of course, hopefully bringing the weekly momentum up as well. So Ethereum certainly leading Bitcoin at the moment. Bitcoin showing signs of sluggishness. So let's just keep an eye on that. And that really is what the CoinDesk article said, the altcoins showing some relative strength there. All right, I think that's where we can leave it for now. If there's any questions, please go ahead and type those in. I apologize that you guys didn't get the links. I'm just going to double check for next week that we get the crypto links out. All right, guys. Thanks, Anna. Let's leave it there. If you need to get hold of me, just shoot me an email, and I will chat with you guys tomorrow. Thanks very much.